Hey, everybody, welcome to our Thursday Night Live. Thanks for joining in. We are talking today with the Tanner Oman Mortgage team. Tanner is here with us today. Hey, Tanner, how's it going?
Hey guys, how's it going?
So go ahead and, I got a slide for you here. Where is it at? Here we go. Introduce yourself. Tell us about yourself, my friend, and let's get
Yeah,
going with this.
I am just one of those happy Rapid City natives that grew up here, went to high school here, went off to college, came back because this place is awesome, and decided to jump into initially financial advising for a number of years. Eventually got recruited over to real estate, and have kind of you know built my way up in this realm. And apparently, I didn't know this up at first, but apparently I'm kind of a nerdy guy when it comes to these mortgage world pieces. So um, this conversation will jump into that a little bit further. We've got a couple award pieces up there. So we've been lucky enough, and Spencer's jumping on as well. We've been lucky enough as a mortgage team to be in the top 1% of loan originators in the nation. A couple of years running. We've made it to our President's Council spot within our company for the last 3 years. So it's been pretty fun ride. But today we'll jump a little bit more into interest rates, what's actually going on, and then make Spencer talk about a bunch of really detailed stuff that she loves.
No, I'm sure. Yeah, yeah. So, Spencer, tell us about, say hi to you, say hi from you, and tell us about yourself.
Hi. Yeah, I joined the Oman Mortgage Group back, gosh, we're going on 3 years already now that I've been with
Yeah,
Tanner, and
yeah.
I worked with him back when he was a financial advisor, so just been watching him do this nerd thing for a very long time.
Nerds all the way around. What fun.
Yep.
So we'll go ahead and get into Tanner's got a whole big presentation put together. See if we can understand it after he gets going on it. So we're going to talk about mortgage interest rates. So my thought from is because we don't, most of us don't really know where do mortgage interest rates come from, Daddy. So let's get an idea of what's in the background of all that stuff. How do interest rates, mortgage interest rates, come from everything in the world? So we'll
Yeah.
get going with that, Tanner, when you're ready.
Sure. We can jump in. The big piece on this is there is more information and more pieces that come into play with mortgage interest rates than I can describe. People can describe or fathom. It's very detailed, very tricky. There's so many things that come into play. So we're going to go through just a couple basic breakdowns, because you see a lot of these terms that I've plugged in here on the news. It's good to understand what they're actually saying and really how big of an impact they play in the mortgage world, which to some extent is a big impact, to some extent isn't a big impact. So we'll just kind of jump into that a little bit. I put some notes up here. So the big thing, that you've probably been seeing on the news is really a discussion around inflation, the Fed funds rate, and then a lot of discussions around like the Fed reducing their balance sheet and doing some other things, macro style, to try to impact what's going on within the U.S. and around the world. The first thing that I plugged in there is a little discussion on the Fed funds rate. So when the Feds are talking about raising interest rates, what they're discussing is actually this Fed funds rate conversation, which isn't mortgage rates or anything like that. It's actually, as you can see in here, a Fed funds rate is what banks lend to each other based on the federal open market committee's recommendations on what they should be lending money to each other. So when a bank has a bunch of extra reserve money and other banks need some extra money, these banks can overnight lend money to each other. Helps obviously keep money fluid throughout the economy, so on and so forth. But this is not a mortgage rate discussion. It's purely a Fed funds rate, bank to bank rate discussion, but it does have impacts in mortgage rates and other things. So the biggest piece, the biggest conversation piece that is going on right now is inflation. any long-term bond, which mortgage-backed securities are bond or similar securities, long-term securities that have fixed interest rates, fixed yields, 10-year bond, treasury, so on and so forth, all come into play. This any long-term investment that has a fixed return is kind of the arch enemy of inflation, or the inflation's the arch enemy of that investment. So if inflation really starts ticking up a lot, those returns that you get are not going to be as meaningful anymore with those long-term fixed investment setups. So
economy 101, more money in, less money here. Yeah. Okay.
Yep, exactly. And so obviously that's a pretty big impact. Right now, if you look at the consumer price index, or not right now, but recently the consumer price index was showing that inflation was actually at like 7.9%, which is the highest that it's been since like 1982, which is really a pretty long amount of time in there, a big stretch of time. So we're at a point where the federal government really has to jump in. They have to start combating this inflation, and they have two ways to do that. The first one is they can increase the Fed fund rate and start increasing the interest rates on money supply, which can sometimes slow things down a little bit. Car loans, credit card interest rates, stuff like that, increase a little, less money gets used. The second option is you can decrease the money supply that's coming in. So as an example, the Federal Reserve can help out by adjusting the amount of money that they're supplying into the economy. And if they reduce the amount of money supply that's available, traditionally those interest rates are going to start ticking back up, and inflation is going to start ticking back down. So the federal government's doing kind of a tight wire walk right now on trying to decrease inflation with these two means, but not doing it in a way that they do it too quickly. And then we come in for a crash landing and the economy goes back into a recession again, which is pretty difficult to do. So the Fed decision does come into play, but it doesn't come into play directly with interest rates. And if you want to jump over to the next slide, if you want to kind of track a little bit of what interest rates are doing, you're not looking at it on a daily basis, but you just kind of want to see what's going on. One of the best tools to use is actually to watch the U.S. 10-year Treasury yields overall. So I just took a little picture of the yield earlier today. So it was at 2.622%, which is, you can see by the chart, if you look on the right, those yields have been going straight up, which is what interest rates have then been following as well. So this isn't going to be a direct correlation, but it's a very good example. If you want to follow this, you can kind of see what the market's been doing. And you can see, obviously, into last year, rates and yields were considerably lower. Now they've been spiking like crazy. So if you jump to the final slide here, the big question is, so what's going to happen now? What's going to happen moving forward? What are interest rates going to do? What are home prices going to do? What are gas prices going to do? All these things are, pretty big questions in regards to how this is going to affect the average person's budget moving forward. So interest rates, truth be told, I don't think anybody really knows what the heck's going to happen, because every projection so far this year has mostly been wrong. So I'd love to say that we can just rely on the experts and we're good to go. Sadly, that's not a perfect answer either. But right now, the experts are expecting that rates will continue to rise for the foreseeable future. Eventually, once inflation is tempered and everything starts going back to normal a little bit, then we should see those rates plateau if the government does a good enough job with increasing Fed funds rate, decreasing balance sheet, so on and so forth. We'll see how well that goes. I would say, like I put in these little notes, the average interest rate's already jumped up to 4.9%. It's likely that it will probably keep going, into the fives, maybe low sixes. Who knows at this point? It's probably going to be a little bit bumpy ride for a while, regardless of the rates increasing like that. So also, gas prices, everything else short term will probably increase. Hopefully, then government takes care of everything and everything comes back down and we're back into a good spot.
Right.
The big piece that comes into play, and Tristan's big piece as far as helping people understand what the heck's going on as far as buying homes, is just because we anticipate that we could see a little bit of recession again coming down the road, and we could see inflation drop back down and all of these pieces, which could mean rates come back down a little bit. That doesn't mean that in your position, if you're planning on buying a house anytime in the near future, that you should wait and see if these rates do go back down. Because the one thing that isn't going to go back down, despite all the media attention and stuff like that, is home prices in the Black Hills area. So if you do decide to wait, you're putting yourself in a position where probably, each year that you wait, you're going to have another 30, 40,000, maybe more, depending on property price, increase in home values, which is not, regardless of interest rates, is not going to put you in a good position. So, Tristan, we can even kind of kick it back to you on that, because I'm sure you have a more, larger knowledge base than we do on the lending
Well, sure,
side,
because right now we're at the point where we have so many people that are still moving in the area. And did you see, I think Elevate Rapid City had a report out that said that we were one of the fastest growing cities in 2021, even over Phoenix. And just insane.
Yeah.
So the only way that prices are going to come down, as I've said before, is we have more homes than buyers. And that isn't happening, nor will it probably happen anytime soon. We're going to lose a few people from the interest rates that are just like, okay, I'm done. We're going to lose a few people because of all of the competition out there. They're just like, I'm done. I'm not going to play this game anymore. So there's some of that's going to go on, but that's overall not going to create a big, huge glut in our buyers that with our few listings that are going to make it happen. Builders are doing what they can to keep things going, but it takes 6 months anymore to build a house, so that there's just no way that they're going to keep all that going. So even if interest rates go up and back down again in a couple of years, prices are going to be up. If they keep up at the same rate, a good 20% again next year maybe. So that could be, you've just lost everything that you might have gained from the downward slope. So
probably lost more.
Right. And I'm never one to say, no, it's a good time to buy, but you have to make sure that, and it's always, of course, in the buyer's perspective, they got to buy when it's best for them. And but waiting to buy to wait to see what the rates are going to do may not be the best strategy overall. It might be just better just to move when you can move. So
it does seem like in general, if you think you're going to potentially want to buy within the next couple of years, jumping into that pool sooner than later and trying to beat some of those price increases and stuff like that is probably the better financial move. Again, as long as you're ready to buy and it puts you in a good comfort position to do so.
Chris they just put an offer in our property a couple weeks ago, 0.5% in 10 days. It went up. So things are going up quick. They're not slowing down. And it's good I know you guys got a couple different lock options, don't you, to play with?
Yep. Yeah. And we can, Spencer can also jump in at any point here too. But yeah, we have.
Come on, Spencer. What do you say?
Yeah, they're called lock to shop options. They're not super exciting in same essence, but technically you can. Once you get a pre-approval completed, you can lock in an interest rate for, traditionally it's going to be 45, 60 days, just to get it locked in. In this market, if it takes you 30 days to find a property, it's probably going to take you another 30 to 40 days to close on that property, so that lock may not be available at that time. So
gotcha.
in markets where you're having an appraisal done in a week and a half and
no fair,
or 3 weeks,
no fair.
Well, yeah, but South Dakota, again, being weird, we just got to do things a little different.
Cool.
But Spencer, as an example, so one of the things that one of the programs that we have a huge number of people focusing on, despite interest rates, is a program called the All-in-One Loan, which is a principal first mortgage payment. So the purpose of the program is to help people pay their mortgage down rapidly, save as much money as possible on interest, and put themselves in a much stronger financial position. And Spencer actually just switched her mortgage over to that this last year, and has been tinkering with that. I use it as well. One of my properties has the All-in-One on it as well, but Spencer jumping in and talking about that and her thoughts on it for the first few months she's been using it. Probably is a good move to get her thrown in there.
Yeah.
Unmute myself. Sorry, guys. Yeah, so I don't know how familiar you are with a principal first mortgage. They don't get talked about nearly as much. They're actually really popular pretty much everywhere. They're just kind of starting to catch on around here finally. Our company's been doing them for a while, but anyway, the concept is it's for really good like savers. If you tend to be someone who's likes to have a lot of liquid money, likes to keep a lot of money in your savings account just for a safety net, whatever it may be. Basically, what the all-in-one account is it's essentially a checking account. So any money that you have in your checking account, they're counting against your principal, but it's still all fully liquid. But that way, and then you're only paying interest on what you would technically still owe against your home loan. So for easy math, let's say you owe $150,000 on your house, and it's worth $300,000. Most of the all-in-ones go up to like 80% of the value of the home, so you have more money liquid to you than you normally would. But let's say it's $50,000 in your savings account, then you're only going to be paying interest on that $100,000 less of the loan you technically owe. So you're only going to pay interest on that small amount. So it just compounds so quickly because you're paying a smaller and smaller payment every month, and that just keeps playing against that principal, and then every month it just keeps getting lower and lower. It's pretty addicting to watch. I joke about it all the time that it's just a fun tool, and for the right people, it's just crazy financially beneficial.
I think the key part there was she used the word fun with mortgage at the same time. That's really weird.
Yeah, well, I wasn't having a lot of fun in my previous mortgage watching it. I'd had it for 15 years and I barely put a dent in it. So, and that's just typical 30-year mortgages. You spend a lot of time just paying interest. So this is
just there. It's just always there.
Yeah. So this is more in your control, and it's something that you become a better saver by having it because you're just like, man, I'm just going to knock this thing out as quickly as possible.
Interesting. Cool.
Yeah, it's pretty amazing.
Cool. Well, let's segue a little bit into. By the way, everybody, anybody watching here, make sure you throw in some questions or comments of any lending type whatsoever. We can certainly answer those questions for you. But I want to talk a little bit about credit scores a little bit. Where are things at right now? Most programs, credit score wise, what's your minimums? What can you work with? Those kind of conversations.
Yeah. So, and we're specifically talking about this, like the standard mortgage programs, FHA,
right.
Conventional, VA type stuff. So there are some, unique programs out there that sometimes do have some options for people that don't have as good of scores. They're just tougher to get into. But general programs, after when COVID was going on, there was a little bit of a decrease on people that, the government was comfortable qualifying. So they, as an example, they kind of bumped up the credit scores that you had to have in order to qualify for a little while there. But they've since, just like everything else, went back to normal. So especially like on the government program side, FHA loans, VA loans, not so much rural development as much, but FHA, VA in particular, they'll still go down to, 580 range, depending on the strength of the file. If you can, it's usually best to be in that 620 range, just because that increases the likelihood of your approval quite a bit, and your interest rates are going to be considerably better above 620 than what they would be below 620. But it doesn't mean you can't qualify below that. It's just more of us giving you some financial advice of what to kind of strive for.
Right. Okay, so if I come to you and my sister comes to you and we have different credit scores, that will affect our rates. I'll have a different rate than my sister will if I've got 600 and she's got 900. So
yeah, if she has 900, that would be pretty amazing.
Yeah, well, 850, whatever the number is.
Yeah. So there will be different breakdowns, and again, it depends on program. So as an example, a conventional loan will have more of an interest rate change for different credit scores, whereas like a VA loan, they're not going to be quite as picky on the credit score, so they likely will, not have as big of a spread of difference between those rates. So it just depends on scenario and everything. But there will be a little bit different if you have 20 credit score or you have 620 credit score, that 620 is going to see those higher rate breakdowns regardless of program.
Yeah. And then do you guys, if someone has some credit, building up credit, do you guys help them with that, or is that something you just kind of push off to someone else and then bring them back when they're ready?
No, we like to help them directly. So, there's a lot you can do oftentimes with very little effort to increase interest or to increase credit scores. So on our side, we usually do a pretty detailed conversation with people on, what they can do. So let's say they're at a 640 right now, and we can tell just by tweaking, 2 or 3 items, we can get them up to 680 or 700 or whatever. We include that as part of the overall discussion on, hey, by the way, if we have you do this, this, and this, we can get these scores up to here, and that will save you this much in rate, this much in monthly payment, so on and so forth, or improve your program that you can use, switch you over to a conventional loan, which will have cheaper mortgage insurance or whatever the breakdown is. So we do have programs that we can help walk people through that conventional discussion around getting those credit scores boosted up and then doing it quickly. Whereas, otherwise you just kind of have to sit there and wait for the credit bureaus to update it itself. We can jump in and have those updated within usually like a week.
Okay, awesome. Cool. Well, thanks, guys.
Yeah, very nice.
So we're going to talk a little bit at the end here about, so what I like about these guys is they do some extra stuff after the fact. So after you close, they're still helping you with different options to get your home paid off, services for your home, a lot more of a financial services help on the back end. So go ahead and talk a little about those services that you guys have.
Yeah, so we as a team, so Spencer already mentioned, I guess I mentioned I was a financial advisor for a good while. Spencer actually worked with me. She was the recruiter at the financial organization, but she actually worked directly with me. I was also a college unit director, which just means I helped coach interns to become financial advisors. And she obviously was recruiting those interns and others. So we worked together when we were in that position. When we came over here to the real estate side, we noticed that there really wasn't much discussion on financial planning, on what to do after you buy a house, on how to maintain the house, on how to get life insurance and, put wills in place and protect your family and all those different pieces. So we kind of took it upon ourselves to start transitioning that. So our job as we see it is, yes, to get you in a house and make sure that you get it in a good position there. But it's not just to give you a giant debt and then be like, cool, have fun, good luck, let us know if you need something. Yeah. So we're going to be afterwards contacting everybody on a regular basis, which we do with our current clients. I like to do financial reviews, not just mortgage reviews, but financial reviews with our clients afterwards. We give away free financial advising classes, so like free Dave Ramsey classes to our clients, help get them back out of debt after we just give them a giant debt type scenario. And then also just, help them get introduced to and work with attorneys to talk about estate planning and wills and trusts and all that. Help them get in touch with financial advisors to talk about life insurance and investment planning or retirement planning.
Right.
It's a big part of society that I feel like we just don't get the education on. I mean, luckily, because I've been in the industry so long, I get the education on it, but most Americans don't. And we want to be more than just somebody that gives them a debt. We want to be somebody that gets them into an extremely good place and financially free.
Right. I mean, there's stuff out there to go find, but you have to be motivated to go find stuff. So yeah, it's nice to have it. Here's the
and it
here's
takes a while to understand it.
Yeah.
It's not like you can just read a book quick and then you're going to know everything. Like it takes a while to learn all that. So yeah, maybe 2 books if you read 2 books.
Maybe two. Yeah, 2 or 3, then you're good. If you read all of the business books of 2022, then you're good, and then you're safe. Awesome. Well, thanks guys for joining. We're about 25 minutes, so we'll go ahead and sign off. If anybody has any questions for these guys after the fact, just reach out to them. I'll put their contact information in the description below. And of course, I hope you all have a wonderful day. Thanks guys for joining me.
Yeah, thank you. Appreciate it. Hopefully we didn't get too much details and make people gloss over, but hopefully it was all good.
Can only do so much, man. Thank you so much, man.
Yep.
Thanks, everybody.
All right, thanks.
See you later.
See ya.
Bye, guys.